David Kelly, Chief Global Strategist and Head of Global Market Insights with JP Morgan Funds, joins us live from New York. David, good morning. Thank you for joining us. It's quite strange, but Fed has reset the entire regime for emerging markets.
Well, yes, and this is how emerging markets have reacted to Fed policy in the last few months. So I'm not surprised, given what the Federal Reserve did today, that we are seeing this reaction in India and elsewhere in emerging markets. But this is probably a temporary reaction. I think, or a temporary action from the Fed. They have paused in reducing bond purchases, so they have not begun to reduce bond purchases yet. I think what they're trying to see is, will we get through the month of October without a budget crisis in the United States? That is the one uncertainty that I think is still out there that they are worried about. And it does show that they are very dovish as a group of individuals. But I still think that logic will push them to reduce bond purchases starting within the next few months. And as that happens, a lot of the trades that people are making right now, will probably turn out to be, less positive. So I don't think you should take it that the Fed will always be easy. I don't think they will always be easy, despite what they did today.
David, that's precisely the point that experts are talking about this morning, that Bernanke's bubble is just about getting bigger, and how long is this fizz going to last for equities? Well, today we're seeing a knee jerk, but is it really sustainable?
Well, I think within the U.S. in particular, I think equities are going up, but they're going up for the wrong reason. The right reason is that the U.S. economy is actually growing relatively steadily, and there isn't much sign of a slowdown. And earnings look pretty good. I think we'll see a very good earnings season in the next few weeks. And so I think that does justify higher stock prices. But instead, stock prices are going up because of this extraordinarily dovish policy by the Federal Reserve, which is removing the opportunity to make money elsewhere. So I think that's what's doing it right now. But if the Federal Reserve does tighten monetary policy or begin to over the next few months, I think at least U.S. equities can be sustained just because of higher earnings. And I think that's probably true around the world also. I know that within emerging markets there'll probably be a negative reaction when the Fed does begin to taper, but I hope that will be short-run or short-lived, because what it really says is the U.S. economy and the global economy is getting back to normal, and if the global economy is getting back to normal, then global central banks need to get back to normal also.
David, do you sense that perhaps we may now build in a case for a bull run in gold prices?
That is a very dangerous case. We've seen a dramatic move in gold today. I think it is possible that a few years down the line we may have significant inflation in the United States for a short period of time. But I don't think that's enough of a reason to hold gold. I think that for most individual investors, I would rather hold a basket of global equities or global commodities, mostly global equities, but commodities as a group. But I don't particularly like gold. I know it's done well, but it's very, very speculative, and it's really moving to different signals over the last 2 years, and it's very hard to predict where it goes from here.
David, last night U.S. bond yields have cracked completely, and they're down by about 6.5%. U.S. bond paper now is at 2.68. What does that mean?
Well, I think that's because the Federal Reserve, one of the things the Federal Reserve said, Ben Bernanke did say that they were a little bit concerned about what might happen in Washington with fiscal negotiations in October. But he also said that one of the reasons they had hesitated to stop bond buying is because long-term interest rates had gone up in the last few months. Now, personally, I find that a little bit puzzling, because long-term interest rates are just going up because people feel better about the economy, and they have to go up. But the Federal Reserve apparently gets spooked every time long-term interest rates go up. And so what I think that tells people is that, if we see another spike in U.S. long-term interest rates, the Federal Reserve stands ready to further postpone tapering. And if you believe that, then it just takes some risk out of buying long-term bonds. And I think that reduction in the risk in the U.S. Treasury market, or the perceived reduction, is really what's bringing some buyers right now.
Right. David, really appreciate you taking the time out and speaking with us. That's the view coming in from David Kelly.